Hello everyone, thanks for checking out my video. It has been a while since I've done a special edition video. So today I want to dive into a really interesting question. Is selling put options in a bull market really as easy as it looks? Well, on the surface it feels simple. You sell puts, the market keeps going higher, your strike prices rarely get tested, you just keep collecting premiums. Sounds like easy money, right? But is it really that straightforward? In this video, I will share my thoughts, highlight some risks that often get overlooked, and help you decide if selling puts in the bull market is a free money strategy or is it a trap waiting to catch the complacent traders. First of all, let's talk about why selling put options feels easy in the bull market. When the market is trending up strongly, it's tempting to keep selling put options because you think that the strike prices will not get breached. Premiums look like free money, and without realizing it, you may sell more contracts than you normally would. Compare that to a market crash or correction, like one of the fastest 10% correction we had earlier this year. Back then, most traders, including myself, were very cautious, especially when you see the market as red as this. Nobody wanted to sell too many put options because we didn't know where the bottom was. But then in a bull market, confidence grows and our discipline for risk management often weakens. This then can lead to complacency. Okay, here's where it gets dangerous. Take a look at this screenshot. I currently have 9 short put positions, all in the green. If they were fully cash secured, I would need about 183,000 US dollars or 235,000 Singapore dollars sitting in my brokerage account. And obviously I don't have close to $250,000 lying around doing nothing in my brokerage account. In short, I am on leverage, or technically speaking, using margin. In case you're not aware, options themselves are already leverage instruments, so even if my trades look good, the risk meter can still climb. In fact, my broker has flagged my risk level as moderate, with the leverage ratio jumping from around 1.1 to 1.3, and this happened while the market was at all-time highs and all my sell put options were in profit. Sounds counterintuitive, right? But here's why. First of all, more open positions means higher margin requirement. Even if all the 9 puts are showing paper gains, my broker still treats them as open obligations. Basically, each contract I sell adds to my margin requirement regardless of whether they are in profit or not. So if I open additional puts, even if they are bullish ones, my use margin increases, which pushes my leverage ratio higher. Secondly, brokers calculate leverage off the exposure, not profit and loss. Leverage ratio equal to total exposure divided by account equity. Meaning to say, my equity may be higher all thanks to paper gains, but my exposure also rises with every short put that I sell or write. And in many cases, the exposure grows faster than the equity, so the ratio ticks up. Next, the broker's margin models usually assume worst case scenarios. Even though the market is bullish right now, margin models typically assume what happens if the stock drops very hard tomorrow. That means selling multiple put options increases my downside risk because I would have to take on more obligations or assignments if the prices fall. So when the brokers factor all this into the margin requirement, it bumps up my leverage ratio. And last of all, premiums collected can inflate exposure. When I sell put options, I get cash premiums added to my account. That might look like profit, but brokers often treat it as additional short exposure until the contracts expire. That means, ironically, being in the green doesn't always reduce risk in the broker's eyes. Well, the last time my leverage went above 1.3 was during the March-April tariff shock and market sell-off, when it spiked to 1.5 times. Okay, now, whether 1.3 times or 1.5 times is risky, it depends on your style. Long-term stock investors with no leverage would see it as risky, but active option traders often operate around 1.2 times to 2 times, though personally I wouldn't recommend going that high at 2 times leverage. Anyway, here's the takeaway and what it means for you. Basically, even in a bull market with trades showing green, leverage can creep up silently. Just imagine, when the market is so green now and my leverage is at 1.3 times. What happens if there is a sudden market shock and huge sell-off? That's when the leverage can spike even faster, and I could face a margin call before I knew it. So the key message is, don't get complacent. What looks like easy money when selling put options in the bull market can quickly turn into painful losses. Okay, if you have watched till here, good job. I have something slightly more technical to share. Personally, I think selling put options when the market is at record high and VIX is relatively low contains some risk and danger. Right now, VIX is below 15 and that presents the following risk. So in case you don't know, options are sensitive both to price changes and volatility changes. If the underlying stock moves against your position, you start losing money immediately. That's delta risk. Simultaneously, if volatility rises, the options becomes even more expensive to close, and that's bigger risk. And when both happen together, it's double whammy, and the losses can be much larger than expected. Okay, if that is too technical for you, here's the layman explanation. VIX, which is the volatility index, measures expected market volatility. When the VIX is low, option premiums are cheap. You basically don't collect much premiums for selling those put options. But if volatility spikes later, the value of those options will rise sharply against you. That makes your short option position more expensive to buy back or close. Overall, in short, that's not the best risk-reward setup. Okay, so to wrap this video up, here are some key takeaways. Selling put options in the bull market feels easy, but leverage creeps up quietly, and risk can explode if the market suddenly reverses. On top of that, when the VIX is very low, the premium reward is small while the risks remain large. The ultimate lesson here is, don't get complacent. What looks like easy money can become dangerous very quickly. There's no free lunch in this world. So it's important to maintain discipline and manage your risk carefully at all times. Market conditions can change faster than your positions can adapt. Alright, that's it for this special edition video. I hope you have learned something. If you found this video useful, hit the like button, drop a comment below, and subscribe for my weekly US stock market updates. Thanks for watching, and I will see you in the next one.